Welcome to Talk Tickers. We're diving into FedEx's latest earnings, and boy, is there a story here. They just posted a massive beat that blew past expectations, but the stock, it pretty much went nowhere. So we're going to dig into why that happened and what it could mean for the stock moving forward.
Okay, so right out of the gate, a 17.3% earnings surprise. I mean, wow. FedEx didn't just beat analyst expectations for the quarter. They absolutely smashed them. This was a huge outperformance that, really caught a lot of people by surprise. So let's put a hard number on that. We're talking about adjusted earnings per share of $4.82. Now, the Wall Street consensus, what everyone was expecting, was just $4.11. So yeah, blowing past the estimates is an understatement. It's a huge beat no matter how you slice it.
And listen, it wasn't just about the profits, the bottom line. FedEx delivered on the top line too. Revenue hit a really strong $23.5 billion, which was also well ahead of what the street was looking for. So what does that translate to? Well, it's a solid 7% growth in revenue compared to last year. And the main engine behind all this, it was really their U.S. domestic package business. That tells us they're seeing higher volumes and they've got some real pricing power right here at home. All right, now here's where the story gets really interesting. It's not like management had an easy quarter, not at all. You can see it in the CEO's quote here. They're basically saying, look, we pulled this off despite some major challenges. They're really driving home the point that this win wasn't luck. This was all about execution and strategy. And that's really the big theme for this quarter, It's this tension between two opposing forces. You've got the company's powerful execution on one side, and on the other, it's running smack into some really serious headwinds from the outside.
So let's break that down. The crucial thing to get is that on one hand, their core business was just firing on all cylinders. I mean, they had better pricing, they were cutting costs with their big new initiatives, and they were landing some key B2B wins. But, and it's a big but, on the other hand, those external pressures were no joke. We're talking about an unexpected fleet grounding right during peak season, a soft freight market, and just a ton of uncertainty in global trade. And this right here, this is probably the ultimate signal of management's confidence. I mean, think about it. Despite all those headwinds we just talked about, they went ahead and raised their full-year guidance. You can see it in the numbers. They're essentially telling investors, yeah, the challenges are real, but our internal strategy is stronger.
Okay, but that confidence comes with a pretty big asterisk for the short term. They're being very clear about a specific cost headwind, about $175 million of it, all because of that MD-11 fleet grounding. And the timing couldn't be worse, right? It's hitting them smack in the middle of the critical peak holiday season.
So let's zoom out for a second, right? Let's get away from all the quarterly noise and look at the bigger picture here. There are some major strategic moves in the works. For one, they're spinning off the freight division. That's a huge deal for streamlining the business. Then there's the whole Network 2.0 transformation, which is all about getting more efficient. And on top of that, they're sending cash back to shareholders through buybacks. These are the big, long-term stories you got to watch.
Okay, so this brings us to the big puzzle, right? The results were fantastic. They raised their guidance. So why didn't the stock pop? I mean, the after-hours reaction was incredibly muted, basically flat.
And the answer really comes down to context. Context is everything here. Just look at this chart. In the 3 months leading up to this report, FedEx stock had already run up almost 24%. Now compare that to the broader market, the S&P 500, or even its own sector. It's not even in the same ballpark. The expectations were just baked in, and they were sky high. So in Wall Street lingo, we call this priced in. Basically, the market already expected a fantastic quarter, and that's why the stock had that huge run-up. So when the great news actually dropped, it wasn't a surprise to anyone. There wasn't a new reason to buy, and that little bit of caution about next quarter, that was just enough to make traders say, you know what, I'll wait and see. So with that whole backdrop, a strong quarter, some near-term issues, and a stock that's already had a monster run, where do we go from here? What's our next call? All right, so here's our outlook for Q3. First, for the results themselves, expect earnings to take a step back from Q2. That's exactly what management told us to expect as they deal with those grounding costs. As for the stock price, we think it's probably going to trade sideways for a little while. Just consolidate. After that huge run, the market just needs to breathe and digest. The real focus is going to shift to that big freight spin-off catalyst coming up in the spring. So our rating on the stock is outperform. Why? Because the long-term story here is just so strong. This self-help transformation they're going through, it's clearly working. Their execution is top-notch. And with huge catalysts like the spin-off on the horizon, we think it justifies a bullish long-term view. even if there's a little bit of choppiness in the near term.
And of course, a quick reminder, this is not financial advice.